This is a Momentum Media production.
Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hi, good everyone. How you going? It's still Tarrant here, enjoying the guitar riff, which sets off another month of Investing Insights with the Right Property Group. Steve Waters, Victor Kumar, gentlemen, directors, Right Property Group. How you going?
Good, Phil.
Going well, mate. That was your choice of the guitar riff, wasn't it? I believe.
No, nothing to do with me. You guys signed it off, and I know Vic sort of sits there in his underwear, thinking he's got an air guitar every now and then when he wakes up in the morning of Investing Insights with the Right Property Group just to get himself in the mood.
I wish you hadn't have said that, Bill. I've got an image in my head I can't get rid of.
Mate, well, I know Victor, our good friend, is from the great island of Fiji, but maybe he's finished because they have the World Championship air guitar event every single year. So maybe we'll see him up there at some point in Helsinki with his black rockin' wig on and giving it a good old belting out the Investing Insights with the Right Property Group riff.
Maybe Vic should be tasked with putting some words, some lyrics to the tune.
maybe Stephen. Maybe that's an opportunity for all of our loyal listeners out there. Number one, can you actually play the riff for us and give us your own version of it? Number two, belt out a song.
The lyrics must include "the markets will fall, the markets will fall."
Yeah, there you go. That's the challenge, and get that challenge right. Victor Kumar, the winning riff. You'll get a lunch with Victor at his restaurant of choice, which I imagine is Rashi's out of Campbelltown.
No, I flesh out, mate. I flesh out.
You still see him out there driving the streets. You know, some people think Victor these days is just an armchair warrior sitting there with his 50 television screens looking at market data. But no, I know for a fact that he's still out there on the ground doing what he does. And
Bill, the fact that you just mentioned that particular restaurant, we haven't got a sponsorship deal with them, so they just got free advertising. So maybe, Vic, you should ask them for a set of plates.
Well, maybe. The guy that owns Rashi's, he actually was living in Campbelltown. He's a Campbelltown lad. I know him well.
He's only one restaurant? Great success story. No, they're everywhere. Rashi's.
Yeah, everywhere. Yeah.
They're great. There's a Rashi's at Tuggerah on the Central Coast. He's a great story of Aussie ingenuity and entrepreneurship. And it's all of these people, Victor, who end up buying investment properties, right? And they make their business, make their money in business and park it in property. It's as old as time.
That was slick. That transition was super cool. Well done, mate. You must be a journalist. Yeah.
I know you're sitting there taking notes going, okay, you see what he did there? He set it all up and bit of fun, some subtle sledging. Indeed, sledging.
Is that the operative word today? Is it subtle?
Subtle, yeah. Subtle. It's like the property market. Very subtle at the moment.
Yep.
Not much happening either way.
No. Well, it depends whose publications you read.
Well, this is it, right? If you read the mainstream media, and they're obviously in the business of sensationalised commentary, they'll still tell you there's blood on the streets, whereas you connect them with more informed commentary, and I would even put you guys inside of that. You're media celebrities these days, co-hosts of Investing Insights, the Right Property Group. You do your Facebook Lives. You're definitely in the media. More informed commentary would say otherwise. This is it right now. And if you can get out the negative sentiments and maybe some of the information you have inside of your ears right now, which is stopping you investing in property, in my view, and I think you guys subscribe to the same thing, is that we're nearing the bottom of this current downward cycle. The smart operators are buying in the dip, and we're definitely in the dip right now. It's how far through the dip we are and how long that dip will be dipped, who knows? But the negative sentiments around property is a handbrake for many people's investment decision making at the moment. So I think maybe we should unpack that a little bit today, guys.
It's an interesting point you say there around confidence and whether you should buy the dip. I think one of the main points people need to understand is around awareness. And that awareness is not just about the data, but it's also from a coalface perspective. And understand, as we've talked about many, many times, is it it's general commentary that we're seeing from mainstream media, which is, I guess, to some degree being led by the Sydney and Melbourne markets. And then everything is kind of compartmentalized into those two markets from an Australian point of view. And I think people should be aware. I think people need to be aware, but it's certainly not the blood on the streets that has been talked about or that has been predicted. That hasn't happened for a multitude of reasons, which I guess we can get to later on during the podcast. But the market is between your ears, always has been and always will be.
And I guess now with the age of fast information transfer, the sentiment is changed quite rapidly. And depending on what media people consume and what articles they read and who they talk to, especially over Facebook, you get this easy sway of whether the market is going up, down, sideways, depending on what articles you consume and, of course, what's also happening within your own household and your own portfolio. And if you take that to the yesteryears, these transitions that we see in the market right now, they were not as pronounced and they were not as quick as opposed to right now because of the transfer of information.
Which is all due to technology, Vic. And we've talked about that over the last probably 7 or 8 years around how technology has the ability to change markets in whatever the asset class is in shorter periods of time compared to what traditionally has been these rolling decades, I guess, of asset value, whether it's up or down. But now because of technology, once again, and at the advent of influencers or finfluencers, things can change very quickly.
Yeah, and it's an interesting point. I haven't really put too much thought to it before, but, this notion of the speed of information change accelerating the way in which markets behave, should we throw out all of the history that we've had over many, many years pre this information environment and say markets don't operate like that anymore? So the speed of a negative market is going to be more condensed and the speed of a positive market is going to be more condensed. So, this notion of property doubling every 7 to 10 years, 7 to 12 years, and you talk there about this sort of decade sort of shift between markets. Is that now going to be in 2 to 3 year spurts? And that is the new cadence for market cycles?
Yeah, we agree. I think that's a great way to put it. It is the new cadence for market cycles. Now, we're not going to put a time frame to it, as in, things will happen within 2 to 3 years. But because of that, the speed of transfer of knowledge and information, in combination with, I guess, a few generations of people that are far more entrepreneurial today than what they were 20 years ago because of technology and the like, these shifts in market conditions will happen quicker. And we've seen that. I mean, we throw away decades and decades and decades of fundamentals on what actually creates a market? No, we don't. But what we can't do is, I guess, interpret and analyze markets from 40 years ago and think that they're going to behave the same way today.
Yeah, just we've got to remember that if we're looking at investing via just data, we are looking at reverse-facing data and predicting forward-facing growth, right? So we're trying to predict growth and get into it with reverse-facing data. Whereas you really need to take that as well as take into account the various cycles, right? The finance cycle, the media cycle, and then the actual ground truth to actually make your decisions. That way, you're not getting caught up with the rapidly changing data, the rapidly changing sentiment. You're still grounded in terms of the fundamentals, and you're still grounded in terms of what you're trying to achieve and not speculating.
So I look at this, and it's an interesting dynamic, and I view it through the lens of there's positive, negatives, there's winners and losers in this. And one of the negatives of this environment, this sort of accelerated cadence of property markets, is that it's going to be a lot less forgiving for investors. So your mistakes will be amplified. However, on the flip side of that, if you can operate smartly within this environment, your wins can be accelerated and amplified rapidly. So you get it right, and what maybe used to take a decade or 2 decades to build a property portfolio in, you could probably, the half-life on that would be very different. You'd be able to move a lot faster and get the wins a lot quicker, but with more risk. I don't know how you operate effectively within that. It's good for you guys in the business of supporting property investors to make those fundamental decisions because, rather than a bad mistake taking 10 years to realise, a bad mistake may only take 2 years to realise. You need to fix that stuff pretty quickly.
I think even if you went further back, it would be, once again, to the transfer of knowledge and how quickly it can be, or let's call it exposure, is around that education piece. Like you go back to when you and I started, Vic, there was nothing. No. Even our industry didn't exist.
We remember going into real estate agents and they would bring out the old lever arch files for, listings that was sort of a bit stale. And now Correct. All you need to do is jump on the net.
Yeah. And so that education piece is huge. It's opened up people's reality to the potential of where they could be, because people don't want to rely upon government funding in their retirement. They have goals, they have ambitions, they have a certain lifestyle that they'd like to live, and they understand that potentially working 9 to 5 and spending your dough is not going to get you there. And it's not how much money you earn, it's what you do with it. And that's all part of that education piece that's now a plethora of information across the interweb. It's just choosing your flavor, I guess, that matches your risk profile.
Yeah. Now, Phil, you mentioned, that it's fairly easy to get into a few winners in property. And if it goes wrong, it's a lot more forgiving than the decades that you need to wait when the information wasn't free flowing. I think the other side of the coin also is that because of the ease of information, when people get it right the first time, because it's not hard to jump on the net and look at, okay, people are buying here, I'm going to buy here, right? And they're not buying towards a plan. This is where a lot of mistakes can happen, because you're just looking at the flash in the pan and you're not investing towards a purpose. And, you get it right once and you think, okay, you've got the formula perfect. And you start repeating that. And that's when the market turns against you. And a good example of that would be, we were in very low interest rates thanks to COVID. And a lot of people jumped in and they were absolute winners because the properties didn't cost them that much to hold. They skyrocketed in value. And now all of a sudden the market's turned. In other words, it's returning to normal. And if they had kept repeating the same thing without taking into account that at some point in time it will return to normal, that's where a lot of people will get financially hurt.
I guess ultimately it comes back down to cash flow management, doesn't it? Mm-hmm. At the end of the day, you can withstand higher interest rates if you have that cash flow component under control. And that would be a combination of household budgets, discretionary spending, and also having chosen the right localities where in today's environment, rents are skyrocketing to somewhat buffer those interest rate rises. Now, if you were investing and you weren't an investor, then there is a big difference, therefore being more speculative and just jumping on to that gravy train of growth with a sharp fall in sentiment and had no plan, well, then probably you're in a bit of a sticky situation if you haven't had any forethought, any planning strategy.
So this market, Steve, it's unique, and you've both been at this for a long time, and I liked your view on it, but it's one that we haven't seen before, and you would think, and the closest comparison we have to try and define this market is the GFC, which you invested through. I started investing at the back end of that, and even then, there's very little clues. You've got this rampant inflation. We still have supply chain constraints. We have interest rates heading north. You would look at a lot of that stuff and compare it to the past and go, yeah, there's got to be blood on the streets with property. However, we're in an environment with very low unemployment. We have an environment where people aren't distressed to sell their properties. You have an environment where people's lending ability has been curtailed by rising interest rates, so serviceability type issues. So a market which is just not really doing anything. It's supposed to be smack bang in the middle of the spring selling season, very lackluster. It's stable. The market is stable, and that's a good thing in terms of the inherent value of where most of us keep our wealth in the property markets. But it's a really, really strange environment. So if we are at or towards the bottom of this particular cycle, and they always say that the speed down and the speed up back to where it was is typically about the same amount of time. So this is the cadence of accelerated property cycles. What's going on? There seems to be confidence coming back into the market. I think this sort of last 6 months of rising interest rates, people have accepted now. Yeah. Family balance sheets are strong. Middle market's performing really well, Victor. Where is this confidence coming from? Like auction rates are holding pretty firm. I think it's a weird market.
Yeah, I think the danger is people comparing the GFC market to today's market and the results that follow. The two are nothing like each other. And as you rightly mentioned, we invested heavily through the GFC, and I struggle to find more than a handful of similar components to today's market and the GFC's market. Just some sort of top line stuff. There was very little intent for participation during the GFC. We didn't have the employment rates that we have today. Back then, it was quite the reverse. Massive amounts of low consumer confidence, and there was blood on the streets. There were mortgagee in possession auctions every other day of the week in multiples. We don't have that today. I think I've done, or as a team, we've done maybe 2 mortgagee in possession sales over the last.
You used to love these, Steve. I remember going to mortgagee in possession sales with you out at the Vegas of the West. What's it called?
Correct.
St Mary's.
Well, all across Sydney. Yeah. All across Sydney. Rudy Hill RSL, I think it was.
Rudy Hill RSL, that's it. Yeah.
But they're not today. Like, we've done 1 or 2 in 12 months, and it certainly wasn't.
Imagine going to one of them right now, how good that would be.
Do you know what? I don't think. Buying. Yeah, I don't think there'd be the value there personally. But look, the 2 markets that we're talking about, the GFC and today, I don't think you could even draw parallels, and I think it'd be a waste of breath to do so. But why are we in today's position where there is still confidence, where there is the want, there is the intent for participation? Perhaps the ability isn't there. Why? Well, the same things that we've talked about probably over the last 24 podcasts. We have an exploding immigration piece and population. We went into this undersupplied. We have the rising cost of construction at its greatest rate in multi-decades, excluding when the GST was implemented. We have a lending system which is far different than what it was from decades ago. And I believe we have a more sophisticated mindset, which is a huge piece of the puzzle. And so people are saying, well, I'm actually in an okay position, generally speaking. And I say that quite deliberately because the commentary we're giving needs to match the general commentary from mainstream media, as we talked about before. I mean, discretionary spending is still way up there. It's huge levels. Now, when people have no confidence, well, that's the first thing that's squared away. That's the first thing that reduces. And that's what the RBA wants at the moment, but it's not happening.
It's not getting it.
It's not getting it. We're mortgage holders are in front of their mortgages more so than probably ever, thanks to potentially products such as the offset facility and the like, as well as in combination with that more sophisticated, educated approach or understanding. So we don't have those pieces of the puzzle that are causing blood on the streets, as you mentioned, or this spiraling confidence piece. It's not there. And people, every day they open their media article of choice, there is something about today's vacancy rates are the lowest in 30 years or in history since data has been collected in some areas. And so they put 1 and 1 together and they say, well, where's my desire to sell when I'm in an increasing income environment, being the rent from the property? I've got some wage growth. Real wage growth is a different, I guess, kettle of fish. And I know my job situation, if that be the case, is more than secure.
Yeah, job security is key.
Correct. Mm-hmm. Job security is a big part of confidence, right? And whilst the interest rates or their upward and downward movements has a bearing on asset value, so too does the flow of credit. And we haven't seen, I guess, the deliberate handbrake being pulled to slow that flow of credit. The banks still want to lend. And we did a podcast with one of our brokers the other day, which will be released very soon. And I urge everybody to listen to that, around how different it is over the last 12 months or even since APRA. It'll be really surprising. So make sure you tune in and listen. So it's a different environment today. So where does that leave us? And this is just purely my opinion. I'm sure Vic's the same, is that give or take, we are at the bottom of the general cycle. the general cycle. There are areas that are still going up. There are areas that are holding firm and tracking sideways. And yes, there are areas that have suffered dramatically. But if we dig deeper and ask, well, okay, where are the areas that have suffered dramatically? You could nearly pinpoint that generally in and around affordability, where we have larger mortgages, lower yields, increasing interest rate environment, and we're not seeing the rate of rental increases to match somewhat those rate increases, acting as a cushion effect. And so the gap is probably getting wider. That's where the sufferance is. Most other places, and I say most quite deliberately, are tracking along just nicely. Thank you very much. Back to the future.
So does that give you clues there where you should be buying, Victor? Sorry, mate.
Well, it comes back to the age-old question, right? Where you can afford and where the fundamentals work, right? And one of the things that people tend to do is try and time the bottom of the market. No one can really do that, right? You know the bottom of the market after it's already passed, but you can see all of the signs leading up to it, and that's what Steve's been saying, is that all of the components are in place to show that it's pretty much at the bottom. The only thing that is perhaps masking that is the lower volume of properties in the market. And that's because a lot of people, with the higher rents that they're getting, plus the fact that they've come off the back of a huge surge of growth, they're thinking, why get rid of something that's really performing well? So your traditional spring season isn't there, plus added to the fact that if they sell that asset, they're not necessarily able to qualify for a loan to replace that asset, right? So if they're home upgrading or downgrading, they might not be able to qualify. And that in itself is the gap in the market that one can exploit, a well-rounded investor can exploit, especially if they've taken into account what we've been advising all along, is to keep your equity liquid for days like this, where your borrowing capacity may have dropped, but you've got surplus cash. You can pad it up and buy the right asset on the assumption that this lending will ease out. And already we're seeing the first snippets of it, where there's some banks that have, won't name the bank, but there's a bank that's come out and looking at 90%, taking 90% of the rent into account. The argument being that the vacancy factor is so low that we will take 90% of the rent. Now, traditionally, it would be 75 to 80%. So the banks in the business of lending money, they will find ways. They'll be obviously EPRA at some point in time will step in and say, well, let's change the assessment rate. Let's dial it back down again. And regardless of where the interest rate sits, the money will start flowing fast again. And you'll have that next surge of growth off the back of rising immigration, good rents, high yields, and the fact that we'll be looking back and saying there was a big growth there. Let's capture that again.
That's a great point, Vic. And you've just given a few little snippets away of that podcast with MLS and Z. I'll just mention one little piece which I think people need to understand. So part of the position that we're in today is because of that APRA handbrake back in 15, 16 or whatever it is, which just decimated participation. Yeah, and participation equals supply. That's why we are today in terms of being undersupplied. But if we fast forward to today and look in the rear vision mirror at what APRA did and with their buffers, we are well in excess of that today. And so what I mean by that, it is not unheard of with some lenders today to be, I guess, servicing you, it would be the terminology, at between 8 and 10%. So that's the rate to the consumer plus the bank's buffer rate. So there goes the participation piece. I mean, or there it is, I should say. So where does that? So if we know that we're being, I guess, throttled in terms of participation due to the circumstances, then what does that do to the future? Where are we going to be for the next 3 to 5 years in terms of supply? So that one could argue, and I'm going to be very, very general here, one could argue that somewhere in the next 2 to 5 years could be another boom. Big call.
Do you believe that?
Are
you just pontificating, Stephen, or do you actually believe that?
No, I actually believe it. My money's where my mouth is, Phil. I'm trying to buy whatever I can. Now, that's just me. Everybody's different. But all the ingredients or just about all the ingredients are there. The big one
where's the boom going to be, though?
Where's the boom going to be? That's the $1 million question, Phil. It's going to depend.
That's why people pay you guys money to find them good property.
That's why they pay us the big bucks.
Yeah.
I tell you what, I'll answer it this way. There'll be obviously supply and demand is always key, as in combination with infrastructure, jobs, affordability, et cetera, confidence. I think the real leading indicators are going to be where the government, whether it be from a state or federal point of view, starts to, unbeknownst to them, or maybe it is known to them, to stimulate the buying activity. So that will be via different grants. First homeowner grant, which we know New South Wales is tinkering with, stamp duty reform, stamp duty tax reform, which we know New South Wales is tinkering with, infrastructure projects, federally dipping into your super, et cetera, et cetera. When you get the combination of all these different grants with a more liquid financial or lending ecosystem, just like we did at the beginning and through COVID, then we have accelerated growth patterns. And I think I'm pretty confident somewhere between the next 2 and 5 years.
And I think looking back in history, again, in environments where you look for where growth will happen based on where the government, whether it's federal or state, are pumping in their money, I think it's going to be different moving forward. They've always paid lip service to growing regional and rural economies. But I think this next cycle, you're actually going to see real skin in the game in that environment. And that's going to change up how people live and how cities evolve. Just having this catch-all going on, investor capital markets, I think this next cycle will change forever how property operates in Australia.
I think that's already happened, Phil. I think that's happened. Thank you very much, COVID. In combination with technology. The technology's always been there, but I don't think
it's technology. Again, it comes down to technology, speed of information transfer. Like, I'm in a different country at the moment and we're still having an engaged and connected conversation. It doesn't matter where I am. It's all the same. So it's going to be a seismic shift. COVID accelerated what should have happened, but I think now there is the clear realisation by state governments that just pumping money into capital city markets isn't going to get you the return on investment that it used to get you.
No, and it's not, in combination with the fact that we've got just superseded immigration patterns, which is necessary, but we need to have the jobs in, let's call it, these non-capital areas. So we'll call it regional areas, and everyone's open to interpretation on regional, but there needs to be the jobs there as well. So clearly infrastructure projects, which then hopefully becomes sort of self-perpetuating within the localized economies, that will, I guess, not just encourage, but that will facilitate large amounts of immigration so that we're not looking at very short-term one-trick pony towns, because we do need the infrastructure, we do need the employment, and we need the connectivity. And that's very, very important. And that is via, once again, technology. So I think you're right. I think the markets, well, actually, this goes back to what you said before. Is it different today than what it was before? And can we use eons of decades past as a good lesson or indicator on what the future holds? No. We can't.
You got to rip it up. I think you got to rip up history. And I'm a student of history, and I think through the study of history, you can largely start shaping how or getting a view of what the future may look like. Yes, and there's you speak about the fundamentals. They're as relevant today as what they have been in other markets, but things have changed so seismically. The fact that we're in the market that we're in right now, and there's no real analogues for that in history because purely it's technology driven. I think what will happen moving forward is that the market that we're in will have other markets like this moving forward. This sort of static, I call it a static market of stabilisation is where we're at right now. And we'll look back in time to this period and be able to go, there's all the clues right there, what the next market's going to be that is very different than what's happened before.
And it's very exciting.
One of the things that we need to keep in mind is that we really need to be investing with bad times in mind. So investing for the bad times, that way you can never go wrong, right? So what I mean by that is that, just because an area is showing a flash of growth because there's, people going in there, but the fundamentals aren't there traditionally. It might not have the longevity. A good example of that would be, an area that's just setting up a mine. That's when the construction phase happens. That's when the action is. And then they automate that, right? So by and large, a lot of the jobs are lost. So we need to be really careful as to where we buy and assume that it's going to get into a bad market. And if we take that approach, we can never go wrong, because you'll always stick to areas that have got really good fundamentals. You'll always stick to areas that have got good liquidity, and you'll always stay away from speculation.
So here's a challenging idea, Victor, sort of looking forward into time. When we look back to this moment right here, is this the new bad market? Is this what a bad market's going to look like in the future?
Look, a bad market usually entails no free flow of credit, right? We can still relatively get money right now. So it's not necessarily the absolute bad market, but for some, it may be. So it's no longer a holistic bad market. It could be a bad market for you because you're at the absolute red line in terms of your borrowing capacity, or you're at the absolute red line in terms of the household budget. So therefore, for you, it could be a bad market. Even if we went to the absolute boom during COVID, for some, it would have been the worst market to invest in because there was no job security, there was no job certainty for them, and therefore the income wasn't there. So they had to sit it out.
I think, Phil, that's a very dangerous question. Is this the new norm in a bad? Is this
journalist, mate? I'm a journalist. I put people in dangerous situations.
It is.
And you're on one right now. Be very, very careful how you answer this.
Mate, I never think before I speak, and it doesn't really matter what the consequences are. It's
a fundamental, Steve.
Yeah, is this go to the fundamental rhetoric. Is this the new norm for a bad market? I actually don't believe it is, and I'll tell you why. Because we're in quite unique circumstances where, just to repeat myself, construction issues, massive undersupply, massive immigration, et cetera, et cetera, et cetera. The next bad market will be a combination of the exact opposite. So it will be a combination of oversupply, static immigration, poor consumer confidence, and an increasing jobless rate. That's what it'll be.
Yeah, I agree. What needs to happen for that to happen, though? We really got to come off the rails, right? Considering
we do.
This is. I think there's a golden period for Australia sort of moving forward, despite some of the strategic challenges in its position in Asia. We need growth. We're an attractive country for people to come and live in, and I think COVID's been an indicator of that. We need the borders open. We need skilled migration coming in. We have good stuff we can still dig out of the ground and sell to people, which is going to sort out the government coffers for some time to come, despite some of the challenges. It's our opportunity to get it wrong as a nation, I believe, through maybe
it's there for us to lose
policy or mismanagement.
Yeah, it's there for us to lose the game.
Yeah,
that's what it is. We talk about immigration and what Australia has to offer. Look what's happening in other parts of the world. That's why we're seeing the take-up rate in terms of immigration for people wanting to get to Australia as the best choice. And maybe I'm being a little biased as well, but considering what else is going on around the world, and it's shocking, we don't have those issues, let's call it. We have a great way of life. You can do whatever you want to do in Australia. It's there for you to succeed. And so people come here, and people have. As I say that, I can think of probably 3 dozen clients which were new immigrants, let's call them, in the last 15 years, and came here with nothing. And I mean nothing. And to see where they are today is just enormous. And it shows you what is possible. Now, I believe, one of very few places in the world that you have that possibility, you have that potential. And once again, because of technology, people get to know what we have to offer. Not to mention the branding exercise of big events like, the Olympics and the like. It's interesting. It's really interesting. But I truly do believe that Australia, the game is there to be lost.
Yeah, I agree. I subscribe to that. So the question, Victor, if we get a bit tactical with this, how do you buy effectively in the dip? Number one, are we in the dip right now?
Well, I believe we are, right? So if you look at it from, there's two dips we're in. One is the finance dip, right? And the other is the actual property dip itself, right? Where sentiment isn't as robust as it was mere 6 months ago, because a lot of people haven't seen these interest rate rises. In fact, a lot of investors have never seen interest rate rises. And we've had the sharpest rise ever in history. So that has created a gap in the market where people are sort of taking a step back and saying, oh, I don't know about this. So it's the informed that are then jumping in and capitalizing on properties that people still need to sell. Now, whether it's a relationship breakdown, business breakdown, or they're just, upgrading, uprooting, going elsewhere, and they do have to sell. And when you factor that in with the finance dip, where people have been caught unawares or unprepared because they were not taking stock of where they were. They thought the rosy times of free-flowing finance with low interest rates will be there forever. There comes in that big chunk of market where you can, if you've already made your equity liquid, it doesn't matter what the lending you can get at the moment, so long as you've got all of your equity accessible to you. You can buy that as a large portion as cash, and as the finance frees up, you can go back and recapitalize, right? And the finance will free up. In a matter of, I dare say, within a year, 2 years, finance will be very free flowing. If I go back to my own experience back in 2006 when I bought a couple of properties back then, and finance is absolutely locked up. And you just simply could not get borrowing based on how I was deriving my income back then and based on lending criteria. To then just a mere 3 years later, the bank was throwing money at me. Right now, the same thing will happen with investors as well. So when you get this market, generally when there's less people, the intent is still there, but there's less people able to buy, and you get yourself set into this market, you're just setting yourself up for a massive upswing. Now, whether that happens in a year, 2 years, or 3 years, I don't think it'll be beyond the 3 years, because you've got all of the ingredients, like Steve said, lining up: construction, immigration, rising rents. There will be the change in sentiment in terms of the finance. So when you've got all of these lining up, it is the gap that you've got where you can just simply capitalize, build up a portfolio, and just wait for what is going to happen inevitably.
Summary. Good time to be an investor, Steve.
If you can afford to, I think it's always a good time. And ultimately, that's what it comes down to, further to Victor's point earlier on, when you can. And I think whilst we're in a very transitional period at this moment in time, I don't think it's any more than what we've seen. In fact, I don't think the transition or the swing is as big as what I've seen in the past. In fact, I don't think it's anywhere near it. And whilst Vic's saying, maybe we're going to see an upside in, his guess is 2 years, he's really making commentary in a very general sense once again, because that's how we need to combat the general media and their opinions. Once again, there are markets doing stuff right now. And even if you want to somehow hang the GFC in comparison, I've probably made more money during the GFC as an investor than I ever did because of the choice that was there. We just don't have, that's the hurdle that we have today, is there's not that overwhelming choice. It's certainly nowhere near as bad as what it was over the last 2 to 3 years with COVID and the big FOMO effect. Once again, spring selling season is not here. And so therefore, when you have record, or we'll call it record low, it's not, but it's very close to it, record low stock on market, you don't need a lot of transactions to create or to change the buoyancy or the cadence of that market. Interesting times.
What do you do about it, Steve? Can you guys, if you're unsure, can you phone a friend? Can you phone Victor Kumar and Steve Waters?
Look, there is a process, but I think the very first thing that anybody needs to do
is help.
Yeah, I need help. I think the very first thing people always should do is take stock of their situation. And if you don't know how to, then start having that chat with people that can help you. And that your own situation is around income and expenditure. It is around surplus funds. It is around goals. It is around a strategy and a plan. We often talk about design a decade because a decade is a hell of a long time. And there are some major milestones. In fact, go back and listen to our podcast around design a decade. It's such a helpful strategy, I guess, in its very loose.
Nothing's changed, right? Still the same
Nothing's
process.
Changed, yeah.
Still the same process. Excellent. All right. Best place to find you, Vic, is the
Just
Facebook.
go on the Facebook or our website, rightpropertygroup.com.au, and there's contact us form. Fairly easy to get in touch with us.
Yeah, and then keep those questions coming as well. We need to do that Q&A episode, gents. I know they're lining up, so that's questions at rightpropertygroup.com.au by memory. I think very good. Always enjoy the discussion, gents. For those listeners who have been with us for many years, thanks for joining us on this journey. And I get a real kick out of chatting with these guys every single month without any real, there's not like a detailed briefing and organisation when it comes to putting these together. We typically like it to be free-flowing ideas because that's when the ideas are challenged and unique and genuine at the point of time. So it works for us and it seems to work for our listeners. So we'll keep doing what we're doing, but we're always interested in positive and constructive feedback. If you'd like us to do something else that we're not doing, please do get in touch. Questions at rightpropertygroup.com.au. Steve Waters and Victor Kumar there, directors there. Give these guys a bell if you want to supercharge your investing journey. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.